Welcome to The Explainer. Okay, let's dive right into this, because today we're unpacking what is arguably the single most misunderstood aspect of the whole artificial intelligence revolution. We're going to look right past the algorithms and the fancy chatbots to uncover the true physical economic impact of AI. Now, for the past 2 years, the narrative has been pretty straightforward, right? AI is this amazing software miracle that's going to make everything faster, cheaper, and way more efficient. But as we start looking at the latest macroeconomic data and real-world infrastructure reports, a completely different and honestly shocking picture is starting to emerge.
For decades, technology has essentially been the ultimate deflationary force. Think about it. You write some software to replace a bunch of manual asks, labor costs drop, productivity absolutely skyrockets, and things just generally get cheaper for everyone. And the widespread consensus right now assumes AI is just the ultimate culmination of that exact trend, automating complex knowledge work and slashing corporate expenses across the board. But what if the exact opposite is happening? What if the actual physical requirements of bringing AI to life are so incredibly expensive that they're actually creating a new inflationary floor across the entire global economy? To really understand why, we've got to look at the sheer, mind-blowing scale of the money being spent right now.
$635 billion. Let that sink in for a second. According to recent on-chain data and industry forecasts highlighted by KuCoin, this staggering number represents the low-end estimate for big tech's AI infrastructure spending in the year 2026 alone. And some estimates actually stretch this all the way up to $725 billion. To put that into perspective, the 4 largest cloud and AI companies on the planet are gearing up to spend more on infrastructure in a single year than the entire gross domestic product of many actual nations. This is not just a standard software update, folks. This is a massive, planetary-scale construction project.
Let's move to and see how this builds when we break down exactly who is spending all this capital. The numbers are just eye-watering. Based on the 2026 CAPEX guidance, Amazon is leading the charge, committing roughly $200 billion. Microsoft is right on their heels at approximately $190 billion, which, by the way, is a massive 61% year-over-year increase for them. And Alphabet is sitting right there, too, between $180 and $190 billion. These hyperscalers are vacuuming up resources at an absolutely unprecedented rate. In fact, JP Morgan expects hyperscaler spending alone to cross $1.1 trillion by 2027. It's just wild.
And this brilliantly illustrates the massive paradox we're facing today. On one hand, we've got the expectation. You type a prompt into a computer, the AI does the heavy mental lifting, and companies save millions on payroll. Simple, right? But then we have the heavy industry reality. To actually make that prompt work, tech companies have to construct massive data centers, lay down literal miles of fiber optic cables, secure gigawatts of electricity, and install highly specialized cooling systems. So the incredibly expensive physical reality of building the AI ecosystem is colliding head-on with our expectations of cheap, deflationary software.
Section 1. The AI Intelligence Crisis. Citadel Securities 2026 Macro Warning.
Citadel's warning really kicks off with a classic economic concept called the substitution effect. Historically, when a factory installed a robot, that robot substituted human labor and the factory saved money. Economists naturally anticipated AI would immediately do the exact same thing for knowledge workers. But Citadel points out that this effect is hitting a massive brick wall. The upfront hardware, the software architecture, and especially the energy costs required to implement AI are currently so high that they just do not immediately offset those labor savings. Plus, a lot of AI applications still require human oversight anyway, meaning they're augmenting labor rather than actually replacing it.
So the crucial point is what analysts are calling the marginal cost of intelligence. In classical economics, technological innovation almost always drives production costs down over time. But with these massive large language models, the cost of training and operating them is increasing exponentially as they get more sophisticated. Citadel's core argument is that the marginal cost of intelligence isn't falling fast enough to justify the trillions of dollars in capital being deployed right now. The cost of getting that next level of smartness out of a machine is bound by very real, severe physical world constraints.
So what exactly are those physical constraints? Well, it's a scaling problem dictated by atoms, not bytes. First up, you need hyperscale data centers. Second, you need highly specialized semiconductor chips, which, let's face it, are manufactured by only a handful of companies globally. Third, and this is perhaps the most critical, you need immense energy. AI data centers run continuously. They generate extreme heat, which means they require highly advanced cooling systems. According to KuCoin's industry analysis, this thirst for power is so intense that AI infrastructure is now directly competing with other energy-intensive sectors, like Bitcoin mining, just to secure cheap, reliable power sources.
Section 2. Beyond the Magnificent Seven. The ripple effect in international markets.
Because AI demands so much physical material, the financial shockwaves are going completely global. Fidelity's research really highlights how second-order industries all over the world are directly benefiting from big tech's massive capital flows. Take the materials sector, for example. Companies like China's Zijin Mining are seeing explosive demand because AI data centers and upgraded power grids require, frankly, massive amounts of highly conductive copper. In semiconductors, Taiwan's TSMC remains the absolute essential manufacturer for the microscopic circuits needed in these chips. And in infrastructure, European heavyweights like Schneider Electric and Siemens Energy are vital for building the power plants and delivery equipment required just to keep the lights on in these massive data centers.
So what is driving this relentless, completely price-agnostic spending spree? Fidelity Portfolio Manager Bill Bauer sums it up perfectly. There is a deep existential fear in the corporate world of missing out. The mindset is essentially, I have to do this, or else I might be out of business in 5 years. This corporate FOMO is literally transforming global supply chains. It's forcing governments and businesses to fundamentally rethink their infrastructure, and it's effectively creating a long-term investment supercycle across energy, defense, and basic materials.
Section 3. Redefining modern portfolios. The macroeconomic waves of AI.
Now, what's really interesting here is how the sheer gravity of this spending is totally warping capital markets. Data from Apollo Global Management reveals a frankly staggering statistic. 87% of year-to-date venture capital net issuance is AI-linked. That leaves just 13% for everything else. AI is totally dominating funding channels. It is sucking all the oxygen out of the room for virtually any other sector looking to raise capital. And it's not just VC, right? We're seeing this exact same dominance bleed right into investment-grade and high-yield bond issuance as well.
Torsten Slok, the chief economist over at Apollo, delivered this incredibly punchy quote that really sums up the whole situation. The new 60-40 is AI versus non-AI. Think about that. For decades, a balanced portfolio meant 60% equities and 40% bonds. But AI is now so pervasive across both equity growth and fixed income infrastructure debt that traditional factor investing has to completely adapt. You can't just balance stocks and bonds anymore. You have to actively manage how exposed you are to the AI ecosystem versus the rest of the traditional economy.
So let's tie all of these threads together. The physical cost of scaling AI is leaving us with some pretty severe structural macro impacts. First, just like Citadel warned, we're looking at persistent AI-driven baseline inflation because of this massive physical buildout. Second, as Apollo noted, there is real upward pressure on U.S. Treasury yields because higher inflation expectations make bonds way less attractive unless they pay out more. Third, tech companies are facing seriously elevated capital costs, meaning they have to generate enormous revenue just to justify these hyperscale investments. And finally, we're almost certainly going to see prolonged supply chain strain, particularly for commodities like copper, energy grids, and specialized semiconductors.
Which leaves us with this final, absolutely critical question. As the transition from a purely digital internet to a heavily physical AI economy accelerates, you really have to ask yourself, is your portfolio positioned for the physical cost of AI? Or are you still trading on the outdated assumption that artificial intelligence is just a neat piece of deflationary software? The AI revolution isn't just happening up in the cloud, it is happening right now in copper mines, power grids, and bond markets. Understanding that reality is absolutely key to navigating the next decade. Thanks for joining me.